Okay, hi, good morning. Today we are starting chapter 13, Irrecoverable Debts and Provision for Doubtful Debts. So in this chapter, you will learn to understand the nature of irrecoverable debts and recovery of debts written off, how to make entries, understand the purpose of a provision for doubtful debt, and make entries to record creating and maintaining a provision for doubtful debts. So what is irrecoverable debt? Is an amount owing to a business which will not be paid by the debtor, or called trade receivable. Okay, and it is normal for business risk. It is charged to the income statement as an expense. So what are the possible reasons for doubtful debts? Number one, when debtor refuses to pay the amount owing to the business. When debtor has become insolvent or bankrupt, when debtor has gone missing, when debtor has passed away. How to record the irrecoverable debt as an expense? So you should debit irrecoverable debt and credit the debtors or trade receivables account. So let's look into this part, walkthrough 13.1. Sachin is a trader who sells goods on credit. He offers customers a cash discount of 2% if accounts are paid within 30 days. Financial year ends on 31st December. So on this date, Sachin sold goods $400 to Bhuvan's stores, which is the credit customer. The account was settled by check on 28 February 20-2. On this date, Bhuvan stores purchased further goods $150 on credit. After many attempts to recover the amounts due, Sachin wrote off Bhuvan's store account as an irrecoverable debt on 30th December 20-2. Sachin received a check from Bhuvan stores for $150 on 31st October 20-3. During the year ended 31st December 20-3, Sachin wrote off irrecoverable debts totaling $820. Write up the following accounts in Sachin's ledger for each of the years ended 31st December 20-2 and 20-3 Bhuvan stores account, irrecoverable debts accounts, and debts recovered account. So let's look into this account. Okay, on February 1st, Bhuvan stores bought $400 of goods from Sachin. So double entry with Sachin's sales account, debit these two amounts that Bhuvan stores bought on the respective date. Then on February 28th, since Bhuvan paid back the amount owed on 1st February within 30 days, so Bhuvan store entitled to get $8 of discount received from Sachin, okay, which is the discount allowed from Sachin basically. So it's 2% times $400 is $8 credit from Bhuvan store's account. And of course, $392 from Bhuvan stores to Sachin's bank account. So what happened to this $150 of sales? According to the question, this is considered as irrecoverable on 30th December 20-2. So we credit from the debtor's account, debit to debit to irrecoverable debts account. Okay, the details is the debtor's information, names, Bhuvan stores. So at the end of the financial year, Sachin will credit this $150 from irrecoverable debt account to income statement as an expense. So what happened in 20-3? During the year ended December 31st, December 20-3, Sachin wrote off irrecoverable debts totaling $820. So if in the next financial year, if the debtor's informations are not given, you just have to debit irrecoverable debt account on the date, last day of the financial year. Details are debtor's return of $820. So who are the debtors are not important here because it's not given in the question. Otherwise, you would have to credit the respective amount from the accounts of the debtors. Okay, then on the last day of financial year, transfer the total of irrecoverable debts of the year to the income statement. So basically, this is how to enter the entries of irrecoverable debts, which is credit from the debtor's account and debit to irrecoverable debts account. So what if the debts that was irrecoverable become recovered? So in this case, we call it recovery of debts written off. It arises when a debtor pays some or all of the amount owed after the amount was written off as an irrecoverable debt. So let's say Buwan store pay back to Sachin in the following financial year. What will be the double entries? Is debit to the Sachin's cash or bank account, which increase the asset, and credit from a new account called debts recovered account, which is an income, will be added after the gross profit for the year. If you look at the entries, what will be the entry? Okay, the entry would be credit from debts recovered account. Then you put a bracket here to specify what's the name of the debtors returning the debt. Okay, put a bracket here, but it doesn't mean debit to Buwan store accounts again, because Buwan store's account has already been closed. Okay, we don't debit into Buwan store's accounts again. So we credit that's recovered account and debit to Sachin's bank account. At the end of the financial year, debit that's recovered account with the total amount that recovered during the year and transfer to income statement. Okay, just pay attention to this. The words debtor written off have been used as no individual name, date, and amount detail have been provided, which refer to this part. What are the ways to reduce irrecoverable debts? By obtaining credit reference. Okay, the business before Sachin doing business with Buwan, how she could reduce the chances of Buwan's owing irrecoverable debts to the business. Maybe you might say that, oh, just not selling goods on credit to the customers. But in practice, this is not always an option. So all possible steps must be taken to avoid irrecoverable debts. So before allowing credit to a new customer, credit references should be obtained. One from the customer's bank and one from a present or previous supplier. To try to obtain some information of this credibility of the customer. The next thing to do to fix and credit limit for the customer, which place an upper limit on the amount the customer can owe at any one time. So each time, maybe just allow a maximum of $200 for Buwan stores to buy on credit, since Buwan has a history of owing an irrecoverable debt. The next thing, to establish a credit limit and later monitoring the customer's account, these are called credit control. try to control the amount of credit allowed to the customers. Lastly, issue invoices and statement of accounts promptly. We have learned statement of accounts invoices in chapter 6, okay, business documents. If the customer still refuses to pay, further supplies will be stopped. Okay, we can stop providing the supplies to the customer until the amount due is paid. Okay, lastly, the business could take legal actions in order to get back the amount owed from the customer. But usually legal action is quite expensive. It's not cheap, but it's one of the way to reduce the amount of irrecoverable debts.